Are you a real estate investor tired of getting denied by conventional bank limits, but not desperate enough to pay the massive fees of a hard money loan? There's a secret middle ground that is helping investors scale massive rental portfolios, and it's called the DSCR loan. If you want to build real wealth in real estate, you need this tool in your tool belt. Prepayment penalty provision. Prepayment penalties are a key provision in DSCR loans that determine if there are any fees associated with paying the loan off prior to its maturity date. Prepayment penalty provisions for DSCR loans have two key aspects. Aspect number one, prepay fee amount, which means the amount of the penalty fee that must be paid by the borrower, typically expressed as a percentage of the outstanding loan balance. Aspect number two, prepay fee duration, or how long the prepayment fee applies, typically expressed in years, but better expressed and thought of in months or payment days. While prepayment penalties represent an additional cost to the borrower, they can actually be advantageous for some investors, since harsher prepayment penalties, such as higher fees and/or longer penalty periods, allow lenders to offer significantly lower rates and better terms. This is because it allows DSCR lenders and note holders to protect their own cash flows in case market interest rates fall and borrowers refinance into lower rates. In this case, the lenders can protect their investment by knowing less refinancing activity will occur in the future, or if interest rates decline, they will still obtain expected returns through the collection of a prepayment penalty fee. For DSCR loans, prepayment penalty provisions are not nearly as restrictive as similar prepayment provisions found in other types of financing, such as commercial real estate loans or CRE loans that are also turned into securitized bonds, commercial mortgage-backed securities or CMBS. For DSCR loans, there aren't ever any lockout periods or portions of the loan term where prepayment isn't even allowed at all, not even with a penalty. And the fees are typically both much lower and in place for a much shorter period of time at the beginning of the term than for CRE loans. Thus, DSCR loan borrowers can utilize prepayment penalty provisions that don't have nearly as much bite as with other loan products, but also achieve the benefits of significantly lower rates and better terms for the borrower. The prepayment penalty fee amount for DSCR loans typically ranges from 1% to 5% of the outstanding loan balance. There may be some rare instances of lenders offering higher fees than this, but in the vast majority of the time, the fees will be in this range. The most common DSCR loan prepayment structure is what's typically called a descending prepay, which means that the fee starts out at a numeric percentage, and then over the course of the loan term and prepayment penalty period, the penalty percentage decreases or descends. A typical prepayment structure is commonly called 5-4-3-2-1, which means that for a 30-year DSCR loan, there is a 5% fee if prepaid in the first year, 4% if prepaid in the second year, 3% if prepaid in the third year, 2% if prepaid in the fourth year, 1% if prepaid in the fifth year, and then no fees due at all for the last 25 years of the term, and no fees due at all if prepaid any time during the last 25 years of the term. While the most common is this 5-4-3-2-1 structure, many lenders offer customization within this structure, with 3-2-1, or only 3 years instead of 5 and starting with 3% penalties, or 2-1 often available. Note that some states allow only descending prepayment structures like this for DSCR loans. Prepayment penalty fees can also be a flat prepay fee, where instead of descending, the fee remains the same for the entire duration of the penalty period. For a structure like this, such as 5-5-5-5-5 prepayment, this means it's a 5% fee assessed on the outstanding loan balance for the full 5-year period, then no penalty applies. The prepayment penalty period simply refers to the length of the time the penalty period is in effect at the beginning of the loan term. The vast majority of DSCR loans with prepayment penalty provisions will have penalty periods in effect for 5 years or fewer, with rare cases stretched to 6 or 7 years. The combination of fee amount and penalty period duration determines how much benefit, lower rate, or fewer points a borrower receives in exchange. Besides the descending and flat prepayment structures, a third somewhat common DSCR loan prepayment structure is also sometimes available, especially in California and Western states. Indeed, it's often referred to as California-style prepay. This structure typically entails a fee amount of 6 months' worth of interest payments, or calculated as interest rate divided by 2, often for the first 5 years of the term. However, what is key and not always understood is that this provision only applies to prepayment in excess of 20% of the principal balance each year. This is a key difference between this prepayment structure and the more common descending prepay or flat prepay structures that apply the full penalty amount to any amount prepaid, with no fee-free prepayments of up to 20% of the loan balance each year in the prepayment penalty period. This 20% freely prepayable provision can save significant amounts for some borrowers, as the fee applies to only 80% of the balance instead of the full 100% in other structures. Further, it can be a great option for investors that choose to do partial prepayments, as there will be no prepayment penalty fee at all if only 20% is prepaid each year for 5 years. Let's pull this all together with our summary chart: common DSCR loan prepayment structures. First, descending prepay, or 5-4-3-2-1 typically. In this structure, the prepayment penalty decreases each year. For example, 5% in year 1, 4% in year 2, etc. This is the most common DSCR prepay structure. The typical fee ranges from 5% down to 1% over 5 years. The penalty period duration is typically 5 years. Next, flat prepay. Here, the fixed penalty fee remains the same throughout the entire penalty period. For example, a 5% fee every year for 5 years. The typical fee is 5% flat fee for 5 years. The penalty period duration is also 5 years typically. Finally, California-style prepay. The penalty equals 6 months of interest, crucially, with 20% of the loan amount prepayable without penalty each of the first 5 years. The typical fee is approximately 3% to 4% based on the interest rate divided by 2 and current market rates, and 20% of the amount is freely prepayable each of the first 5 years. The penalty period duration is typically 5 years, but can also be shorter sometimes. State-by-state prepayment penalties. One of the biggest sources of confusion with DSCR loans is running into restrictions on prepayment penalties based on the state in which the mortgage property is located. While most DSCR lenders will have standard prepayment penalty options available as general default options, such as 5-4-3-2-1 or 3-2-1, there are some states where prepayment penalties for DSCR loans are not allowed or restricted in fee, length, and structure. While this would be an unfortunate headache to worry about in and of itself, what makes things worse is that the state laws and regulations that determine these restrictions are often vague and interpreted differently from lender to lender. As of 2026, there are many states where, regrettably, there isn't a legal consensus on whether prepayment penalties are allowed, restricted, or banned outright. This includes large states with lots of DSCR loan volume, including Pennsylvania and Michigan. Experienced DSCR borrowers with geographically diverse portfolios have likely run into situations in which different DSCR lenders provided materially different quotes or options based on their interpretations. And these lender policies and interpretations, which frequently change, can confuse even the most experienced and up-to-date mortgage broker or loan officer. These negative surprises, especially if occurring in the middle of a live deal process, can cause serious heartburn among borrowers and everyone involved in the effort to close loans successfully and quickly. Time for an FAQ break. Why do restrictions on offering prepayment penalties for DSCR loans exist in some states? Ultimately, these restrictions stem from well-meaning regulations on residential mortgage loan borrowers to prevent them from signing up for significant debt obligations without understanding hefty fees and complex provisions. However, the intent and purpose of many of these regulations were for everyday borrowers typically taking on owner-occupied home loans, not real estate investors using loans for the business purpose of generating cash flow from income-producing rental properties. This original intent makes sense. For example, a married couple that consists of an engineer and a teacher might make a couple of home purchases in their entire lives and shouldn't be expected to understand or fully comprehend the nuanced nature of fees and penalty provisions. Additionally, if an unsophisticated borrower misunderstands the prepayment penalty provisions of their documents and ends up defaulting, then they could be out on the street and potentially homeless, an outcome nobody likes to see, and the states should arguably enact regulations and rules to protect against. Like most regulations now governing mortgage lending in the United States, rules around prepayment penalty provisions stem from lessons learned from the 2008 financial crisis. However, restrictions on prepayment penalties through state-level regulations don't make nearly as much sense for DSCR loans, since these properties are strictly utilized for a business purpose and the borrowers are choosing to invest in real estate as a business and income-generating activity. A much higher level of sophistication should be assumed as compared to an average homeowner that isn't in the business of real estate investing. Additionally, a foreclosure of a rental property would almost always have much less severe consequences as losing an owner-occupied home. One involves potential homelessness, the other, while not ideal, generally means a loss of an income stream and some savings. In this context, it should make a lot of sense that there are rules against prepayment penalty provisions for government-sponsored conventional mortgage loans, but for DSCR loans provided by private lenders strictly to investors, the choice by the individual DSCR loan borrower to choose the length and structure of their prepayment penalty and enjoy the commensurate lower interest rate and fees should exist. Pretty much every DSCR lender will always allow an option with no prepayment penalties too, just with much higher fees and rate. As of 2026, it remains an unfortunate aspect of DSCR loans for borrowers and lenders alike, as many state statutes continue to be stubbornly applied to business purpose DSCR loans for rental properties in some cases, even though it's likely that's not the true intent, and these interpretations cause more harm than help. Despite the likely unforeseen negative consequences of some laws and regulations regarding prepayment, it is the reality of DSCR loans right now. Best thing to do as a real estate investor and well-informed borrower is to stay up to date and ask your mortgage broker or loan officer early and often what their specific policies are on prepayment penalties in the state or states you are investing in. It always makes sense to double check and keep these in mind when underwriting your deals, and even when in the early stages of exploring new markets and real estate investing opportunities. As a helpful resource, please see below in our description for an overview and understanding of general interpretations across the DSCR loan industry of state-by-state policies on prepayment penalties. Note that these state-level restrictions provide an overview of standard DSCR loans secured by 1 to 4 unit properties, and DSCR loans secured by multifamily, or 5 to 10 units, mixed use, ones that include commercial units, or portfolios, 3 or more individual properties under one loan, also called cross-collateralized, generally are interpreted to have no statutory or lender restrictions on prepayment penalties anywhere. Let's put this all together with a summary chart. Prepayment penalty rules for DSCR loans by state. First, fully allowed with no restrictions. A full range of prepayment penalty options are allowed in states like Alabama, Arizona, California, Florida, Texas, Washington, and many others. Second, fully allowed with disclosure restrictions. A full range of prepayment penalty options are allowed, but the lender must include a state-specific disclosure document in the loan package. This applies to Colorado, Oregon, and Wisconsin. Third, fully allowed with borrower-type restrictions. A full range of options are allowed, but the title must be vested in an entity such as an LLC or a corporation and not an individual. This applies to Illinois and New Jersey. Fourth, allowed with restrictions. This includes states with prepayment penalty period lengths and/or fee amounts subject to certain limits, like a maximum of 3 years or a maximum fee of 1%. This applies to states like Michigan, Mississippi, Ohio, Pennsylvania, Rhode Island, and Virginia. Fifth, varied interpretations among lenders. These are states where some DSCR lenders may treat the state as fully allowing all prepayment options, while others may interpret that restrictions apply depending on internal policies. This applies to Delaware, Kansas, Maryland, and New Hampshire. And finally, prepayment penalties not allowed at all. No prepayment penalties are allowed for DSCR loans securing 1 to 4 unit properties in these states. This applies to Alaska, Minnesota, and New Mexico. Now, a quick but important note. The information provided in this video is for informational and educational purposes only and is based on publicly available legal sources, lender compliance interpretations, and regulatory materials current as of June 2026. While every effort has been made to ensure accuracy, this content does not constitute legal advice, nor was it prepared or reviewed by a licensed attorney. Prepayment penalty rules vary by jurisdiction and may change due to new legislation, court rulings, or regulatory interpretation. You should always consult with a qualified attorney or compliance professional in your state before making any financial decisions or relying on this information for legal or contractual purposes. Additionally, unless otherwise noted, this overview focuses on those 1 to 4 unit residential property DSCR loans. Generally, prepayment penalty restrictions do not apply to DSCR loans secured by multifamily properties with 5 or more units, mixed-use buildings, including those with retail or commercial space, or cross-collateralized loans secured by portfolios of 3 or more properties. Each lender may interpret or apply state laws differently, and internal policies may be more conservative than legal minimums. Borrowers are encouraged to review actual loan documents carefully and seek personalized legal guidance before proceeding. And there you have it, the complete guide to understanding DSCR loan prepayment penalties. While DSCR loans are an amazing tool, every real estate journey has its hurdles. If you want to learn how to navigate them like a pro, head over to harpooncapital.com and fill out our Contact Us form. When you do, we'll send you our completely free ebook, 10 Obstacles for DSCR Loans and How to Overcome Them. Don't forget to like this video, subscribe to the channel, and check the description for all the links we mentioned today. Happy investing, and we'll see you in the next video.